Shall we start?
We can start, sir.
Okay. I think last week we couldn't have the full session. Sorry about it. That's the new normal in the country. We may have to face this situation. I don't know how many of you can join now on live classes with power interruptions and with these difficulties. However, we hope we can conduct the full session today. Can you tell me up to what point that you discussed the topic last week? I share the presentation. You started discussion on money market deposits. Sorry, money market products. So if someone can tell me up to what point that you discussed. I was told something about treasury bills. Is it correct? Did you discuss all those things? This one? Or shall I start with this point? Price of a treasury bill. Is it okay?
You can start from that point, sir. So we can start from treasury bill pricing.
We can start from there. No, I was checking whether the session recording is on or not. I think it's on.
It's on, sir. The recording sign is there.
Recording is on, no? Okay, then we can start. Okay, we'll start with treasury bill pricing. You know what is a treasury bill? It's a short-term instrument used by government to borrow funds, and there are few things that we should know about treasury bills. What is face value, what is discount, and what is price, things like that. What do you know about a treasury bill? Can you tell me what you know about a treasury bill? Who is the issue of treasury bill? Government, yes. Then what is the nature? What are the maturities? I think this was we discussed. What are the maturities in Sri Lanka?
It's a short-term instrument.
Yes.
We can
what are the
use
maturities?
below 12 months.
Below 12 months, but indeed at the issuance there are three specific maturities. What are those? The government of Sri Lanka issues only
3 months, 6 months, and 12.
three maturities. What are those?
3 months, 6 months, and 12 months.
3 months, 6 months, and 12 months. But exactly, if we talk about the maturities, we don't call it 3 months. 3-month one is 91 days.
Yes.
Then
182
days,
and 364 days.
364
4 days.
So those are the maturities that we use. Hundred 82 days and 364 days. These are at the issuer, at the origin. But with the time, existing treasury bills, majority of existing treasury bill will go lower. However, maximum 364. What else? What else you know about treasury bills? What is the interest rate paid? Is there any coupon payment or any interest payment? Have you ever heard about treasury bills are issued at a discount? What does it mean by this discount? Any idea? So basically, treasury bill is an instrument used by governments to borrow. Is it clear? So borrow for a short period, up to 1 year, 364 days in case of Sri Lanka. So what do you know about borrowing? When someone borrow a particular amount, then after that, what do you do as a borrower? You have to, as a borrower, you have to pay interest, and before on a particular date, you have to pay the sum that you borrowed. But in treasury bill, and up to some extent, even in treasury bonds, the borrower will not, may or may not pay the same amount that the party borrows. But when the borrowing is done, that means when the treasury bill is issued, borrower promises to pay a certain amount on the maturity date. Borrower promises to pay a certain amount on the maturity date. That amount we call face value. The amount the borrower promises to pay on the maturity date. That is we call face value. Assume it is 100. For simplicity, we assume that is 100. But one treasury bill, we assume face value is 100. What does it mean? Assume say there was an auction last week, settle on Friday. So government issue a treasury bill, say for 91 days. Then on the maturity date, that means this is March, 91 days means it falls in somewhere in June, maybe June 4th. On that date, the government will pay 100 rupees. That's it. In treasury bill, there's no interest. Does not pay interest. There's no interest. What government say? I want to borrow money today and I will pay 100 rupees on the maturity date. So then what is the amount that you are willing to lend to the government? You will get 100 rupees on the maturity date. Will you lend 100 rupees today? Will you lend 100 rupees today? Because only thing you are going to get is 100 rupees on the maturity date. That's it. Then what is the amount that you will lend to the government today? Will you lend 100 rupees or more than that or less than that? As an rational investor, what would be your action? If you lend 100 rupees today, on the maturity date you get 100 rupees. Are you happy? This is today on the issue date. This is maturity. You lend 100 rupees today and on the maturity date you get 100 rupees. Are you happy? This is after 91 days. Are you happy? Will you do any investment like this? Are you with me? Can you all hear me?
Sir, you are muted.
I hope you can hear me.
Yes, sir.
Yes. Okay, please respond. Otherwise, I'll think that there's some technical problem. So, government is going to borrow or pay 100 rupees in 91 days. What is the amount that you are going to lend today? Will you lend 100 rupees today?
No.
Government wants to borrow money. What government promises is to pay 100 rupees in 91 days.
No.
Then you won't lend 100 rupees today, because then if you do that, you don't get anything any return or anything back other than your investment. So you won't do that. Will you lend more than 100?
No.
No, that is also no, because you lend more than 100 and on the maturity date you get only 100. Then you are losing. Generally not, but there are instances even now in the world people do that, but that's a very extreme case. We'll forget about it. You don't do that, but then you will lend lesser amount than the face value. That means this 100. The face value is the amount the government agrees to pay on the maturity date. So the difference between the face value and the amount that you pay, this is the, that is we call price, that you pay a price to buy a treasury bill. That difference we call is the discount. This is the amount the government agrees to pay on the maturity date. This is the amount you lend. So the difference is we call it as the discount. So you know this concept, discount concept. If you go to a shop, so there may be an item saying price is 2,500 rupees, and it may indicate 10% discount. This is the quoted price. There's a 10% discount. What is the price that you pay? What is the price that you pay to buy this item?
2,250.
200, 2,000,
250.
250. How did you calculate this?
10% discount on 2,500.
Yes. If you calculate the discount, what is the discount? What is the discount amount? It is on 2,500 and 10%. Then the answer is, what's the answer?
$250.
250. Then how do you get the price that you are going to pay? It is the quoted price, 2,500 minus 250. Then you get 2,250. Or on the other hand, in a different way, you can calculate this as the 2,500 into 90%. How did you get this 90%? 100% minus this 10 discount of 10%. Still you get the same answer. Clear? That's how you calculate discount in your day-to-day life. Clear? But when it comes to markets, money market or financial markets, you can't do the same thing, exactly the same thing. It would be slightly different way, because in these examples, these are instantaneous discounts. But in treasury bills, there's a time value. You get 100 here, say you pay 95 here to buy this, then what is the discount? Face value is 100. This is the price that you pay. Then what is the discount?
5%.
Just 5 rupees. This is say for 91 days. Then what is the discount rate? Someone already told that it is 5%. Is it correct? Is it 5%? What if this bond is for 182 days? Then what is the discount rate? %. Still 5%. Even if it is a 1 year bond, 364 days, discount rate is 5%. In financial markets, we can't do that. Yes, on the face value, it is 5%. But there's a problem. For different tenors, we have to think about that time factor. That's why you can see on the screen, we have this equation to calculate the discount rate. We use this equation to express the discount rate as an annualized rate. Here, in my previous example, the price that you paid 95, face value 100. For 91 days, yes. For 91 days, discount is 5%. But if you do the same thing for 182-day treasury bill, for the 182-day period, discount is 5%. But what is the annualized rate? For a 1 year, what is the discount rate? So therefore, we have to annualize this rate. How do we do that? This is the simple discount rate that we calculate. That's how we get this 5%. Discount 5 divided by face value. Remember, we always calculate the discount on the face value. So we get this discount 5% for a 91 days. So therefore we divide it by days to maturity. That means 91. Then we'll get what is the discount rate for a 1 day. Then we multiply that by number of days per year, 364. Then we'll get the discount rate for a 1 year period. So therefore, even you see the discount rates, 91-day discount rate is 8%, 182-day discount rate is 9%, something like that. Those are annualized rate. Remember that. Those are annualized rate. So that is the discount rate in treasury bill. Not only in treasury bill, the same concept is applicable for commercial papers and many other, we call them discounted instrument products, financial instruments that are traded on a discounted basis. What does it mean by that discounted basis? Investor will pay a lesser amount than the amount that he will get on the maturity. So that discounted product, for those, the discount rate is calculated based on this equation. I hope now you are clear about this equation. Why do we have this 364 divided by days to maturity? Is it clear? This equation?
Yes, sir.
Any question? If not, we'll move into the next slide. There's an example. Suppose you could buy a 364-day treasury bill at a price of 90 rupees and the face value is 100 rupees. Calculate the discount rate. This is very straightforward because the maturity period is 364 days, 1 year. No need to do any adjustment. You can get the discount rate simply by dividing the discount by the face value. So first we have to calculate the discount. What is the discount? That is face value minus price. So the face value is 100 and the price that you paid is 90. So the discount, remember there are two words. One is discount, the other one is discount rate. When you talk about discount, it is the rupee amount or the dollar amount. When you call discount rate, it is the percentage value or in percentage points. It's not just the just an amount. So discount is 10 rupees. Then the discount rate is 10 divided by 100. You can use this part, then it will become 364 divided by 364. So therefore the discount rate is 10%. Annualized discount rate is 10%. Clear? Is it clear?
Yes, sir.
Okay, if I change this to 182 days, what would be the discount rate? Assume this treasury bill is issued for 182 days and you bought it at 90 rupees.
20%.
What is the discount rate? Sorry,
20%.
20%. Yes. How did you get it? You can see here discount is 10 divide by 100, then this day adjustment comes into play. 364, it is there, but this is divided by 182. This part becomes 2. So 10 times 2, 20%. If it is 91 days, what is the discount rate? Then it is 40%. So when we go by these two, it is easy. Whenever it is 91 days, for a year we have 4 times of 91. So therefore, what we have to do, multiply this by 4. When it is 182 days, there are 2 periods of 182 days in 364 days. So therefore, multiplied by 2. But these 91, 182 and 364 days will be there only at the issue date. But with the time, remaining maturity of a treasury bill will go down. Still, you should be able to do this calculation. Assume if it is 35 days, what is the rate? Remaining maturity is 35 days. What is the rate? Now, the only change here is instead of 182 earlier, we have to put 35. So the rate would come around somewhere 115, 18. What's the answer?
$104.
104. Yes, 104. Then the discount rate is 104%. It's a huge discount. In practically, you won't see this much of discount. But here, what happens? We kept this huge 10 rupee discount unchanged. We change the number of days. Just to explain how the discount rate changes with the time to maturity. Is it clear? Any questions? Any questions? If not, okay. Assume there's a treasury bill issued as 182-day bill. 60 days gone now. So it was issued as an 182 days, and now 60 days has gone. That means the bond or the treasury bill was issued in the history 60 days. Now today you buy it at 96 rupees, and you know the face value is 100. What is the discount rate? The treasury bill issued originally for 182 days. You bought it at 96. What is the discount rate? So what does it mean? This is time 0. When the treasury bill is originally issued, this is 182 from that point, and now 60 days has gone. This period is 60 days. We are here today. What is the remaining maturity of this treasury bill?
121 days.
100,
Sorry, 122 days.
122 days. So then what is the, you bought it today at the price of 96. Then what is the discount rate? What is the discount? Discount is 4 rupees. 100 minus 96. Discount is 4 rupees. What is the discount rate?
It's 11.93.
4 rupees divide by 100 multiplied by 364 and divide by what's the figure goes there? You divide by what do you put? What is x?
122.
100. What is this x?
122.
122 because that's the remaining maturity. The remaining life of the bond bill is 122. You get a 4%, sorry, 4 rupees discount for 122 days. So then what is the annualized rate? What is the rate?
11.93.
Sorry,
11.93.
11.93.
Yes.
Correct. Others got the same answer.
Yes. Yes.
Yes. Okay. So it is clear. Then we'll move to the next concept. Sorry. We'll move to the reverse calculation. If you know the discount rate, how do you calculate the price? What we did here. You knew that discount rate is 10%, quoted price or the what you get at the end, like quoted price is 2,500. Then what is the price that you pay? How do you calculate it? How do you do that in a treasury bill? So what we have to do the reverse calculation here. Say we'll go to the original question here. It is easy. If I ask the question, there's a 364 treasury bill and the discount rate is 10%. What is the price that you pay? Instead of giving this figure, this is not given. This is given. Discount is given. Then I ask you to calculate the price. How do you calculate? Since it's a 364 days, it's easy. When you get a 10% discount, what you have to calculate? 10% of 100, 10 rupees. Then the discount is 10 rupees. Face value 100, 100 minus 10, 90 is the price. You can do that for a 1 year treasury bill. But when the time is less than that, again you have to do that day count adjustments. So you can do that using this equation. This has factored all those things, everything. Face value, discount rate, days to maturity, and 364. If we go back to the previous example, what we did, remaining maturity 122 days, discount rate is 11.93. Is that the answer we got? Face value 100. You do the calculation, you should get price of 96 or closer to 96 if there's any rounding off in this answer. Can you do that and see whether you get something closer to 96? Face value 100, 1 minus discount rate is 11.93. Remember, in this equation, it just say discount rate. Whenever you apply that discount rate, you should apply it as a decimal, not the percentage figure. So therefore, I'll put it as 1, 1, 9, 3. Days to maturity 122 divided by 364. You should get the answer closer to 96. You may not get exactly 96 because rounding off. Got it?
Yes.
Yes. So maybe there's another example. Yes. Suppose you could buy a 90-day treasury bill at a discount rate of 5%. What is the price that you pay? It's a 90-day treasury bill. Discount rate is 5%. So then what is the price that you paid? This is the face value 100. Face value 1 minus 0.05 is the 5% discount rate. Remember it as a decimal number. Then 90 days divided by 364, number of days per year. Then you get the answer 98.7637. Clear? Any questions? Any question? Okay, this is discount. But remember, in the markets, sometimes you use the discount rate, but the most common word we use is the yield. What is yield? What is yield?
Yield means gain.
What is your gain? On top of what that you calculate your gain? Okay, if we go back here, you bought this treasury bill paying 90 rupees. And after 1 year period, you get 100 rupees. What is your gain? What is your rate of return? Your gain is 10 rupees, correct? In rupee amounts, your gain is 10 rupees because this is the price that you paid. This is the price that you receive. Then your gain in rupee terms is 10 rupees, the same as the discount. What is your rate of return?
It is 10%.
10%. Rate of return. What is your return? Rate of return. Is it 10%?
No, it is a bit higher than the 10% because we invest 90.
Yes.
So
You
it's
invest
like
only 90 rupees, but you get 10. So you calculate the rate of return on top of your investment. So therefore, the rate of return is 10 divided by 90,
90.
it should be more than 10%. Maybe. What's the answer?
It's 11.11.
11.11. So that's the difference between discount and the yield. This rate of return, we call it as the yield. We calculate yield on top of the investment. So that's why in this equation, this part is there. What is FE, face value minus price? What is face value minus price?
Discount.
That's the
Discount.
discount. Discount divided by the price. That is the yield. Yield for the particular period. But we have to annualize it. Again, we use the same concept. 364 divided by days to maturity. Clear? Then the next equation shows you, if you know the yield, what would be the price? The reverse calculation. If you know the yield, what would be the price? How to calculate the price? There's an example. Assume an investor purchases a 90-day treasury bill at a price of 97. What is the yield? Remaining maturity is 90 days. Price is 97. Then the discount is 100 minus 97, 3. Divide by 97. This is the price that you pay. And adjusted for number of days. Remaining maturity is only 90 days. Then divide by 90 multiplied by 364. Then the yield is 12.5. Clear? Any question? Now don't get confused with the discount rate and the yield. Discount rate and yield are two different things. Any question? In the uploaded PDF version also, is it same like this? Can you see this slide properly in the PDF version? Can you see this question properly?
Can't say, sir.
You can't see even in the PDF, no? It's nothing but what it say. This one. you are going to buy a 1-year treasury bill with 100 par value. Par value means the face value at a yield of 5%. The yield is 5%, but it's 1 year. That means 364-day treasury bill. What is the price that you are going to pay? That's the question. Then again, if you go back to this equation, you can see 1 plus yield into days to maturity divided by 364. Since it's a 1 year or the 364-day treasury bill, this part becomes 1. Then it is 1 plus yield. That's why it is there in the answer 1.05. Then this can't be. Yes, face value is 100. 100 divided by 1.05, you get 95.24. Face value 100 divided by 1.05. 95.24 is the price that you are going to pay. Is it clear? Is it clear? Is it clear or you have any questions? The question basically asks, there's a 1-year treasury bill and the yield is 5%. What is the price that you pay? When you go back to this equation, face value 100, yield is 5%, days to maturity again 364. 364 divided by 364 equals 1. Therefore, the denominator becomes 1.05. 100 divided by 1.05. 100 divided by 1.05. The price is 95.24. You pay a price of 95.24 to buy this board. Clear?
Yes.
Can you do the same exercise if yield is 6% and get the price? And do the same thing if the yield is 4% and get the price, and let me know the prices. If the yield is 6% for a 1-year treasury bill, the price is 100 divided by 1.06. What's the answer?
94.34.
90,
4.34.
94 point.
Yes, 94.34.
94.34. When the yield is 4%,
96.15.
90.15.
6.15.
Now, if you can see the yield and the price, what is the relationship that you see? 5%,
When the
6%.
yield goes high,
Okay.
when the yield
Put it
goes
into
high,
order,
price,
4%, 5%, 6%, and note down the prices. You will see what would happen.
when the yield goes high, the price goes down.
Yes. When the yield goes up, then price goes down. So this is we call yield price relationship, inverse relationship. Yield and price, there is an inverse relationship. When the yield goes up, price goes down. When yield goes down, price goes up. This is a very basic concept that you should remember all the time. This is not only for treasury bills, even the treasury bonds or any other product. This concept is valid. We will see this when we discuss fixed income securities as well. The inverse relationship between yield and price. What do you think about discount rate? What would happen when the discount rate increases? What is the relationship between discount rate and price? If the discount rate increases, what would happen to the price? Okay, so this is very simple. You go to a shop. In say you went to two shops. In two different shops, the same item, the quoted price is same, say 2,500 and 2,500. In one shop it says 10% discount, other shop it says 15% discount. From which shop would you buy that? Shop 1 or the shop 2, where they give 10% discount or 15% discount? Same item,
15%.
identical item. Sorry, which one?
15% discount.
15% discount. Shop 2, why?
The price really goes down.
Price is less, you pay less. So then what's the relationship between discount and price?
Discount is up, the price down.
Yes, again the inverse or the negative relationship. When the price discount rate goes up, price goes down. Similar to yield. Then what is the relationship between discount and yield? If the discount rate increases, what would happen to the yield?
have positive relationship.
There's a positive relationship. If the discount rate increases, yield also increases. And can the discount rate would be higher than the yield? Discount rate is higher than yield. Is it correct? Can it happen?
No,
No. Why?
because if there's a discount, then we invest less than the
Yes.
return
Yes.
amount. So
Discount rate is discount divided by face value. Yield is discount divided by price. So same figure divide by two different figures, face value and the price. Which one is high, face value or the price?
Face value.
Face value. So when you divide the same number by a large number, you get a small figure. So therefore this is wrong. But can the discount rate be equals to yield? Can the discount rate be equal to yield? Again, only in the extreme case when there's no discount. Face value equals price, then only these two equal each other. So when there's no discount, discount rate equals to yield, which is equal to 0. These are the general conditions, but if the interest rates or the yields are negative, this may not hold. Okay, now try to answer the next thing. If the investor requires a return higher than 5% with respect to this, what would happen? If he needs more than 5%, what he would do, he will discount it at a higher return. Then the price will go down. That's what we discussed. Okay, what is the discount rate in this example? Not that 6% or 4%. If the yield is 5%, 1-year treasury bill, the price that you are going to pay is 95.24. What is the discount rate? What is the discount rate? What is the discount? The face value minus the price that you paid. What is this? 4.76. Then what is the discount rate?
4.76%.
4.76%. This is easy because it's a 1 year. So you no need to do any adjustment. The discount rate is 4.76. Again, you can see discount rate is lower than the yield. Yield is 5%. Discount rate is 4.76. Shall we move forward? So in this slide again, it will explain for other different maturities. That means for the shorter maturity than the 1 year, what would happen? We already discussed. Same thing, 5% annualized return, but 182 days. Then what is the price that you pay? 97.56. What was the price earlier? 95.24. So you pay slightly higher price because you hold it only for a small period. But as a rate of return, you still earn the same return, 5% return. But again, if the investor needs more than 5%, then he will discount it at a higher rate and buy it at a lower price. Try this one. Assume investor request pays 98,000 rupees for a 91-day treasury bill worth rupees 100,000 par value. The annualized yield of the security will be. So basically, you are buying at 98 for a 100 face value for a 91-day period. You are buying a treasury bill with a face value of 100 by paying 98 for a period of 91 days. What is the annualized yield, or simply what is the yield? So this is the discount face value minus the price divided by the price into day count fraction. 364 divided by 91. So 2 into 4, it is 8%. You earn an annualized rate of return of 8%. You earn a 8% annualized return. Clear? So mostly these two equations and these two equations. Indeed, if you are good at maths, you need to remember only one equation, then you can derive the other one. They are also the same.
So sorry for disturbing. In earlier, sorry for disturbing. In earlier equation, is it 8.16 the yield?
Is which one?
That 100,000
This
by
one?
the investor buying 100,000 bill buying at 98,000.
8.16 or maybe.
Because we have to divide 2,000 by 98,000, I think.
2019. Yes. This won't be 2 divided by 98. It comes as 2.04. Yes. If you take the exact figures, it comes as 2.04 into 4. Yes, this is correct. Then it comes as 8.16. 16. Yes, that's correct. Yes. Anything else? So that's why I ask you to all the time do the calculation by yourself. Now, since he has done this, we could have identified this. Otherwise, later you will do the correct calculation and you get 8.16, but the answer given here is 8%. You would worry what's wrong with your calculation, and you will spend a lot of time on that. So it won't happen if you do it here, and there may be, yes, maybe rounding off, but we should not do this type of rounding off, because this 16% is a huge amount when it comes to billion and millions and billions. It's a huge amount, so you can't avoid that. So this rounding off should not happen. So then this equation gives you the relationship between yield and the discount rate, because we know yield and the discount rate both are related to discount and the price and the face value. When you combine these two, so basically this price we can replace with the discount equation. So that price can be replaced by this part. This part can be equation and do some calculations. You would get, not calculation, some manipulation, mathematical manipulation. Then you can derive this equation. I'm not going to explain those steps. However, this equation gives you the relationship between yield and discount. That means if you know the discount rate, you should be able to calculate the yield. If you know the yield, you should be able to calculate the discount rate. Clear? So, but so far, most of the calculations or the examples we have considered are exactly on the issue date, say 91 day, 182 day, or 364 day treasury bills. We did few examples that 122 day and 90 day treasury bill. So those are the exemptions. That means you trade in after the issuance date. So here also we are going to discuss what would happen if you sell a treasury bill prior to maturity. If you can remember, earlier I discussed a problem. Originally the treasury bill was issued for 182 days, but after you bought it after 60 days. So, and we price on this date, we price the treasury bill. That means somebody who has bought it here on the issuance date is going to sell it after 60 days. Now we are going to discuss what is the yield or the rate of return he has earned. That's the basic idea here. That yield can be calculated based on this equation. Again, what does it mean? SP is the selling price. What is the price that he sells the treasury bill after some period of time? P is the original price that he purchased. N is the number of days that he holds it. When you put these numbers, you will get the yield or the rate of return, annualized rate of return for that investor. It is something like that. Say, assume you buy something. Say you buy a land, paying 50 million rupees. You hold it for 6 months time and you sell it at 52 million rupees. What is the rate of return? You bought it at 50 million, hold it for 6 months and sell it at a price of 52 million. What is the rate of return? How do you calculate it? The difference between the price that you paid, that is 50 million, and the price that you sold it, 52 million, that 2 million is your profit. To make it a rate of return, you divide it by your invested amount. That means the price that you paid, 50 million. 2 million divided by 50 million. So that is the rate of return, but it is for a 6-month period. Then you to make it annualized, you multiply that by 2. Same thing here, the same concept what we discussed. Only difference here is instead of the face value, we use the selling price. If you take this equation, this is same as the yield equation what we discussed here. See? P minus P divided by P, 364 divided by days to maturity. Only difference here is in this equation, N is not the days to maturity, but it is the holding period. Number of days that you hold the investment. Instead of face value, what is the price that you sell that treasury bill? I think, okay, there's no example in the slide. Say we'll assume you purchase a treasury bill at a price of, you purchase a treasury bill at a price of 96.5. Then after 58 days, you sell it at 97. What is your yield? You purchase a treasury bill at a price of 96.5. You hold it for 58 days, for a period of 58 days, and sell it at a price of 97. What is your yield? Okay. Do you want to know what is the maturity of this treasury bill? Do you need that information, whether it's a 91-day treasury bill or a 182-day treasury bill, or what is the remaining maturity? Do you need that information? No, which is not required. What you need, the purchase price, the selling price, and the holding period. How many number of days that you hold that investment. That's all that you require. So what is the yield? Selling price is 97. Purchase price is 96.5. You divide by the purchase price. Multiply. There are 364 days per year. In treasury bill calculations, in Sri Lanka especially, we always use this 364 days per year. So therefore, to do annualize, we use 364 days. What is the holding period? It is only 58 days. You would get the answer. It should come close to 3%. What's the answer?
3.25%.
3.25.
25.
3.2517. This is your annualized rate of return. You bought it at 96.5, you hold it for 58 days and sold it at a price of 97. So this calculation, the concept is valid for any other investment. This is how we calculate the rate of return. Only difference may be this 364, whether we use 364 days or 365 days. That's the only difference. Any question? So that's all about treasury bills and basically discounted products. Even the commercial paper calculations would be the same set of equations. Any question before we move into the other products? Now you should be able to identify or explain the concept, discount rate, and the face value as well, and the price and the yield. Face value, price, discount rate, and yield, then rate of return, again as a yield, realized yield. One more thing, if we go back here, this one. This investor requires a 5% annualized return and he bought it at 97.56 because that is his requirement. He's happy. Okay. Now assume it is only for 182 day period. Say after another 6 another 80 days. He holds this for a 80-day period and sold this at 98 rupees. What is his yield? Has he realized this 5%? He holds this investment for 80 days and sold it at 98. What is his yield? What is his yield? Can you do that calculation? What's the answer?
2.05.
2.05.
05.
5. Any other answers? Yes, 2.052. So this answer is correct. So even though you bought it at a yield of 5%, unless you hold it until the maturity, you won't realize that yield. Clear? So this 97.56% price is derived based on the yield of 5%. So you will realize that price only if you hold it until the maturity. If you sell it before that, you may or may not realize that yield, or maybe you realize lower yield, or maybe you realize higher yield. That depends on the market conditions. That is one thing that you have to remember. When the market interest rate changes, price of these treasury bills changes on continuous basis. Therefore, realization would be different from your expectation unless you hold it until maturity. See this in this example, investor wanted a 5% rate. He bought it at that rate, but he couldn't hold it until maturity. He sold it after 80 days at the prevailing market price, 98 rupees. Now the realized rate is only 2.05. Can you see this Word document? Can you see this? So basically what it says, an investor needs
No, sir.
6% yield on a 182 days treasury bill at the issuance. So then what is the price that he has to pay to buy this? Then assume he bought it at that price, and after 90 days the same treasury bill is trading at a yield of 6.25%. Now investor wants to sell this. Then what would be the price that he will get, and if he sells at that price, what would be the yield for the investor? So you have to do 3 calculations. First thing is, what is the initial price, then what is the selling price, then what is the yield. Can you answer the question? So my advice is, when you try to do this, first write the equation. That is my advice. What is the equation for the price? Price equals face value divided by 1 plus yield into 364 divided by number of days. Correct? This is the equation. Then what we have to do? Substitute the numbers. What is the face value? 100 1 plus what is the yield? What's the yield that he requires? 6%, that means 0.06, and number of days 180, the price that you get. What's the price that you get? What's the answer? Can you see this Word document?
No, sir.
No. Now,
Yeah, okay.
so this is the question. What's the answer for the first question? What is the price that he is going to pay? First thing, what ask you to first write the equation, then substitute the numbers, then get the answer. What's the answer?
$89.28. 28.
9.2715 something. 2857. Okay. She will say 8.929. Okay. Now, after 90 days, the yield has changed. Now the current yield or the present yield is 6.25%. What would be the price that he would get if he is to sell these? Still the same equation. Only thing is they have to change the yield. And not only that, now what would be the remaining maturity period? From 182 days, already 90 days gone. Then what is the remaining maturity?
92 days.
92 days. Now see what would be the price. What is the price?
$80.17.
80.17. Is it a gain, or if he sells it at this price, is it a gain or loss? Is it a gain or loss? What is the yield for this investor? Is it a gain or loss?
Loss.
It's a loss. We bought it at 89.29. Now the price is, even after 90 days, now the price is 80.17. So he will make a loss. We'll calculate the yield. The equation for the yield. It is the price minus the purchase price divided by purchase price into 364 divided by holding number of days that he held it. So what are the figures? $80.17 is the selling price. Purchase price 8.29 divided by 89.29 into 364 divided by 90. What's the answer?
Loss of 4.13.
4.13.
Yes.
Any other answer?
Negative 41.131.
Negative
Okay.
41.31. Which one is correct? 4.13 or 41.31? Others?
It's 41.13.
Sorry, 41 point.
41.31.
31. So this is correct. Yes, I got the same answer. sorry, when you do this calculation, it comes as a decimal 0.4131. So to make it a percentage, you have to multiply it by 100. I have not put that. If you want to make it clear, you can put it this. Correct? So this part, this 100% part you can omit. But when you get the decimal figure, you have to multiply that by 100 and get this. So now you can see what would happen in an interest rate increasing environment. If you hold this until maturity, you will realize 6%. Whatever the interest rate, it doesn't matter at the end. But if you want to resell it before that, this is the loss that you realize. And on the other hand, this reflects your opportunity cost. If you didn't invest it, wait few more days and invest it in at the higher rate, you could have earned more. Okay, now you can do the same thing. Keep this 6% story as it is. Now assume instead of 6.25%, assume what would happen if the yield is 5.75. Do the same calculation and see what is the result. Oh, sorry. First instance, assume the yield remains same 6%. Now see what is the picture. Sorry, you didn't realize that this in this here, this should be other way around. Then all these numbers are incorrect. So you just follow me. We'll have to go back. This 5.75, 6.25. I have done a mistake here. To calculate the price, it should be other way around because yield is quoted for 364 days. What we need is for the given number of days. Then 182 divided by 364. Isn't it? Go back and check this equation. This yield is quoted for and it's annualized. So therefore, we have to first calculate it for 1 day and multiply it by the number of days. Then it should be this way. This may be more than that. 100 divided by 1.03. 97.0 Have you noticed that this equation is incorrect? It should be other way around. For this is correct, but here we did a mistake. Point 0.06. Now you get a positive return. This one should be 97.09 divided by 97.09. Have you all recognized that? What's the mistake that we have done? We used the wrong equation. $98.4 minus 5.6. That's correct. I was wondering how that 41% came. now do this. What would happen if this remains at 6%? We'll do it. Now what's the remaining number of days? It's 92 days, yes. What's the price? Is it correct?
Excuse me, sir.
Yes.
I have a question that in the slide you have given price calculation equation that indicates 1 plus yield into dates to maturity divided by 364.
That's the correct equation. Yeah, in this Word document, earlier we used the other way around. This part was
Sir,
wrong.
then
Now
it indicates that 1 plus yield. That amount should be
no.
multiplied by.
The same thing. This 1 plus yield multiplied by this. Okay, I got your
No, it's
confusion. No,
we are getting another answer
no,
by
no.
substituting that equation.
Let me show. No, what you tell is this one. No? This one. Is there any difference between these two? Remember, if there's no parenthesis here, all these go together. So therefore, whether you write it like this or like this, there's no difference. So you should not add 1 to the yield, then multiplied by this fraction. No, you have to do this part first and add 1.
Okay, sir, thank you.
If you want to, if that's the way, here there should be another parenthesis. So if we put all it would be like this. If I put it like this, then it's different. Then you add 1 plus yield. Sorry, the best way would be to put the parenthesis here. If it was like this, then these two are not equal. Then they are different. Then only you can add yield, add 1 to the yield, then multiplied by this fraction. But it is not the case. I think you got it now.
Yes, sir, thank you.
So that's why be careful when you use parentheses. If you don't use it properly, then you will get an answer, but the answer is incorrect. So now the price is 98.51. Then we'll calculate what is the gain. $98.51 minus 97,099. Holding period is 90 days. This is correct. We purchase it at 97.09. And the other thing, say now this 98.51, it is sort of rounded off. The answer doesn't come like this. If you store it in the memory with all the decimals and use it again, you may get slightly different answer. So be mindful about that one as well. You get 5.91. Correct? Have you got these numbers? Can you confirm that?
Yes, sir.
Yes. But has anyone used the full figures without rounding off? Can you confirm that this is correct? Or you got the same answer? If you have you got any other answers? Now you can do the same question. Now we'll reduce this number of days. This part. First part remains the same. The second part, assume he holds this only for a 10-day period and the yield increases to 6.25. Then what would be the answers for the next two questions? Assume he bought it at 6%, paying 97.09. Yes, 97.09. After 10 days, the same treasury bill is trading at 6.25. Then what would be the new price and what is the yield for the investor? We can do the same thing. We have 170 days remaining. Yield is 6.25. What would be the price? Let me know. $97.13. Is it correct?
Correct, sir.
Okay, then what is the return? Don't you said that correct. If you do this calculation, you get this answer. That may be correct. Just check whether I have substituted the figures correctly and whether I have used the equation properly. You do it without looking at, you do it by yourself, then compare it with my answer. If there's any discrepancy, let me know, then I can investigate. 98. No. Now it's 97.13. This is only for 10 days, not for 90 days. What's the answer? What's the answer you get? This is not 5.91. This is the old answer. What's the answer you got? $1.65. Is it correct? Have you got the same answer? Have you got the same answer? Can you confirm, please? If not, tell me. We can redo that and see what's wrong if you don't get this answer. Okay, if not, I assume this is correct. And
Is it 1.50, sir?
price, say, face value remains as it is. Likewise, fill it until 10 days and 0. Then try to calculate the price when the yield is same as original 6%. Try to calculate the price for all these days. See what would happen. Let me share. Create a table like this. Yield is 6% original yield. Say what would be the price. This will show you price will gradually increase towards 100. Then you can do the same thing with 6.1 or something like that. See what would happen. There will be instances you may incur a loss. Assume what would happen. The yield decreases to 5.9. Then you do the calculation. For this, you don't want this because it's the original price that you bought it at 6%. But after that, after 10 days, yield has increased to 6.1. Then what is the price? After 20 days, yield has increased to 6.5, 6.1. What would happen? Likewise, do this calculation and do these changes as well. Say what would happen if the yield goes to 6.5. Likewise, try different combinations and see what is the result. In some instances, before maturity, you may incur a loss. In some instances, you may incur profit. Do this exercise and understand the behavior of interest rates and price before the maturity and what would be the return. So that is sort of homework. Do it before next week. I'll show you the results next week. Okay, now I think that's enough on the treasury bills. Do you have any questions? Before we move into other products, we'll take a break. But before that, I would like to know whether you have any questions. So if you don't have any questions, we'll take a small break, about 15 minutes. Now what's the time? It's almost 11:10. Yeah, can we come back 11:20? We'll try to finish this topic today, the money market fall topic. We'll try to finish that today. So we'll take a small break and come back in 10 minutes. Shall we start, please? Okay, I'll move forward. So that's all about treasury bills. one of the major money market instruments. Then we'll move into Fed funds. This is just for your knowledge. This is not applicable for Sri Lanka, but we have a almost similar market in Sri Lanka. We call it interbank interbank market, interbank call money market. But in the US, we call it the Fed funds market. What does it mean? You know, even in Sri Lanka, all commercial banks, they have to maintain part of their deposit liabilities with the central bank. We call it SRR, Statutory Reserve Requirement. And each bank maintains an account with the central bank. So you maintain funds in that account. The same is applicable in US as well. They have Federal Reserve Banks, 16 Federal Reserve Banks located in different states. Banks maintain accounts with one of these Federal Reserve Banks. And when they have excess funds in that account, they lend that to another bank who is in a deficit. That market is called Federal Fund market. So in that, what do we do, or what the participants do? They transfer funds for other parties, other banks who are the participants of this federal fund system, or those who maintain accounts with the Federal Reserve Banks. They lend each other. That's the basic idea. So through that, they transfer the ownership of funds immediately. So if one bank is in a deficit to maintain its SRR requirement or to meet other liabilities, they can borrow it from another bank. Mostly very short periods, overnight, mostly overnight borrowings, but there can be some terms like 7 days or 1 month, but mostly the market is concentrated on the overnight transactions, and it is unsecured. There's no security taken through this Fed fund transfers. So this is the US market. We'll move into the Sri Lankan context. We call it interbank markets. Then banks in Sri Lanka borrow or lend funds among themselves through the central bank account, similar to Fed fund transaction. Basically, banks do these transactions when they cannot meet the borrowing banks borrow that funds basically when they cannot meet the statutory reserve requirement. The banks, those who have excess on SRR, they will lend that money to the deficit banks. That's the basic in the interbank market, and this is large scale wholesale market and in large denominations. It may be in billions, not even in millions, maybe 500 million kind of, but it's in big sizes, big ticket sizes. We use different names. Funds buyer, we use the name funds buyer to represent the borrower. And as mentioned earlier, we lend immediately. So whatever available in our accounts will transfer to the other account immediately. So that is we call selling. The lender is called the seller of the funds. The rate is decided by the market itself based on the demand and supply. Those who have more money, they will tend to lend at a lower rate, but those who have large deficit, they will tend to borrow at a higher rate. So likewise, depending on the availability and the demand, the rate will be decided. But the thing is, there may be money market brokers involved in this market. Those who need funds will inform the money market broker, we need this fund. Those who have excess funds will inform the money market broker, we have this much of money, we want to lend. So then the broker will match the borrowing and lending requirement and complete the transaction and inform both parties that you have lent this much amount to this party at this rate. Basically, before they conclude the transaction, they get the confirmation or call back both parties and come to an agreement, then inform both parties. And this is not negotiable. What is meant by negotiable? You can transfer your ownership to another party. You have a claim against one bank, you can sell that claim to another party, say treasury bill, what we discussed. Once you purchase a treasury bill, you have a claim against the government. On the maturity date, government will pay you. But if you don't want to hold it, you can sell it to another investor or another bank. Then you get the funds depending on the price that you agree from the buyer, not from the government. So we can trade between investors, that is negotiable. But when it comes to interbank market deposits, you can't do that. When you lend some money to another party, another bank, it is just an agreement or the transaction between the borrower and the lender. Lender cannot transfer that claim or the ownership to another party. So therefore, interbank market transactions are non-tradable or non-negotiable. So on the maturity date, the borrower will pay back to the lender. So therefore, in the interbank market, there's no distinction between primary and secondary market. There's only just one market between borrowers and lenders. So these are the commonly used maturities: overnight, from next. That means, okay, overnight, what does it mean? Overnight, you lend today, you get the maturity tomorrow. So this is today, t equals 0. This is t equals 1. You lend on this date and you receive funds next day. You come to the agreement today, you lend money today, you receive your funds back tomorrow. Then what does it mean by Tom next? I explain you the concept trade date and settlement date. Can you remember? Trade date and the settlement date. So in the overnight transaction, trade date and the settlement date are the same date. Maturity date falls next day. This is maturity. But in a Tom next transaction, this is the trade date. Today you enter into the agreement. This is the settlement date. Tomorrow you transfer money to the borrower. Day after tomorrow is the maturity date. Tenor for the deposit is just 1 day, but the difference is the starting date and the maturity date. In overnight also, tenor is just 1 day. You place the deposit today, you get maturity tomorrow. But in Tom Next, you transfer money tomorrow. That means you lend tomorrow, you get your money back day after tomorrow. That's why it says Tom Next. Then when it comes to Spot Next, as we discussed, generally we call spot is T plus 2. So T plus 2 is that means after 2 business days, you deliver funds or you lend money to the other party. On T plus 3, the next day, the party will pay back you. Spot week means you place that or you transfer money, you lend money on the spot date, but the maturity would be after a week from the spot date. So therefore T plus 9. From this date to this date, there are 7 days, 1 week period. That is spot week. Those are the very common maturities in the interbank market. So not only that, the almost same concepts we will use in the foreign exchange market as well, not the overnight, but Tom Next, Spot Next. In the swaps, when we discuss about foreign exchange swaps, we'll discuss or we'll use the same jargons, the same concepts applicable there. So hope it's clear. So this is a description of that overnight transaction date. You transfer money. Next day you will get the money back. So funds are deposited or loaned for the night after a transaction is agreed and repaid on the next business day. When it comes to Tom Next, you deposit the funds 1 day after the transaction date and you receive funds in 1 day. So if the transaction date is 9th, you place the deposit on 10th and you receive maturity on 11th. That is Tom Next. Same Spot Next. Transaction date or the trade date is 9th. You place the deposit. That means you transfer your funds to the borrower on 11th. The borrower will repay you on 12th. Spot week. You place the deposit on the spot date and you receive your funds after a week, 7 days from the spot date. Remember that this is very important. You start counting days from the settlement date. That means in this case from the spot date. Those are the common maturities. Then the other product available in the money market is commercial papers. This is the equivalent of treasury bills, but issued by corporates. The same product, almost same product, with same features, but issued by corporates. But the maturities, there's no hard and fast rule like 91, 182, 364 days in government treasury bills. It's not like that. Commercial papers are short term, that means less than 1 year maturity, but the maturity period can be decided by the borrower, corporate, depending on its requirement, it will be decided. Then when they decide it, they will think about their requirement, the corporate requirement of the corporate cash flow requirement. Not only that, what is the view or the preference of the lenders, whether lenders will prefer to lend for a 1 month or a 3 month or 6 month or 9 months or a 1 year, whatever it is. There can be preferences depending on the market conditions. So the corporate will try to borrow at the cheapest rate and while fulfilling the fulfilling its requirement. So therefore, the maturity period will be decided by the issuer or the corporate depending on its requirement and the market condition. So the aim is to get liquidity to the firm or the corporate. So the major issuers in the world, not in Sri Lanka, financial institutions, such as finance companies, bank holding companies, and insurance companies. When they have short-term funding requirement, they will issue commercial papers. But not only financial institutions, but still other corporates also use this market to borrow for a shorter period. When they decide this, they will think about whether it is easy to go for a bank and ask for a loan or overdraft kind of thing for a small period, or whether it is good for issuing a commercial paper. There are pros and cons of issuing commercial paper against borrowing in other ways. So companies, they will assess and come to a conclusion what is the funding requirement and funding source. It's up to them to decide it. But here our focus is how to evaluate these and how to price, what are the features. So again, price of a commercial paper is decided using the same equation like in treasury bills. Only difference is number of days per year. This equation is based on the US market, because if you can remember, in the US money market instruments, they use 360 day count basis per year. So therefore, same is used by the corporates when they issue corporate or the commercial papers. Depending on the market, this figure may vary, whether it's 360 or this one, whether it's 360 or 365 or 364, that depends on the market. And in the covenants or the issuance documents, they will specifically mention what is the day count that they use. And again, this is a discounted product. Why? Commercial paper also selling at a discount. Why? The borrower promises to pay a certain amount on the maturity date. The borrower won't specify the amount that he is going to borrow, but only the maturity amount. So depending on the market, what is the required rate of return for the investors, the discount rate or the yield will be decided. So all the calculations what we did on the treasury bill are applicable for commercial papers. So that's why we have discount rate here. It can be based on the yield as we discuss in treasury bills. And commercial papers are unsecured. That means there is no collateral back this issue. It's just a plain issue. Issuer has promised to pay the amount on the due date. There's no any asset behind this cash flow, or there's no any other collateral pledge against this borrowing. There's nothing. That's why it's called unsecured. So therefore, for the investor, it's slightly risky. But that riskiness can be measured or evaluated through the credit rating. Credit rating agencies, they will rate the issue and the issuer and assign credit rating. If the issuer can get a higher rating, triple A or double A plus, something like, or double A even, depending on the rating, the required yield or the required rate of return will be lower. But if the rating is not good, then the required rate will be high. So therefore, the borrowing cost will be high for the issuer. Rating is not the only factor that decide the required rate of return. Market, say, similar treasury bill rate. What would be the similar maturity treasury bill rate? What is the performance of the issuer? Whether they have defaulted earlier, whether they have the cash flow, whether the business is doing well, what is the economic situation of the country? All those things will be factored. What is the inflation and the tenor? All this will be factored into the equation when they decide the yield. Then the next product is certificates of deposit. Okay, this is sort of fixed deposits that we place. We go to a bank, give 100,000 rupees, and we say, okay, this is a 3-month deposit. The bank can keep that funds for a 3-month period. I'm not going to ask it back before 3 months period. Certificate of deposit is a sort of deposit like that, fixed deposit. But the difference here is in certificate of deposits, there can be two versions. There can be tradable one and non-tradable ones. I don't see this product again in Sri Lanka, certificate of deposits. What we have, non-tradable one, just the fixed deposit. You place it, that's it. You can get it on the maturity date. You cannot transfer the ownership to another party. But in other countries, the certificate of deposits can be tradable. You can transfer your ownership or the claim against the bank to another party and get your money earlier than the maturity date. So what is why the issuers, they use this certificate of deposits? Then they have some certainty. They know that these funds will be available for a certain period, fixed period. It may be 1 month or 2 months or 2 weeks or 1 year, whatever it is. The borrower knows that these funds will be there for a certain period. That will help them to, especially for banks, to manage their liquidity requirement. So the investor holds this certificate. The advantage is the certificate can be tradable if it is a tradable deposit, and it available in small denomination like 100,000 USD in US market. As I mentioned, in Sri Lanka we don't have this tradable one, but fixed deposits almost same like this. You can make it in almost any denomination. As I mentioned, the advantage to the bank is they know that it's for a fixed period. So therefore, since the issuer can, or the depositor can transfer it to anybody, there's a flexibility given to the depositor. Due to that flexibility given to the depositor may be able to lend at a slightly lower rate than a normal deposit or a normal borrowing by the bank. That's the advantage to the bank. They get some certainty about the amount, the liquidity, and they can borrow it at a slightly lower rate. And the denomination are in small amounts, not big amounts like interbank markup. This tradable certificate of deposits in calculations, there are simple interest calculation as well as the discounting method as well, because let me explain you that. I'll go to Can you see this screen? Blank slide. Can you see this?
No, sir.
Sorry?
No.
Can you see this?
No, sir.
No. Okay, hold on. Now?
Okay.
Yes. Okay. What I wanted to explain. Okay. Now? I don't think it's working. You can see this. blank slide. Yes?
Yes, sir.
Okay. Now in a commercial certificate of deposits, say it's like this. You go to a bank and you deposit 100,000 rupees for say 90 days. At say 10%. Now you pay 100,000 on this date when you place the deposit. What is your maturity proceed? On the maturity date, what do you get? On the maturity date, what do you get? Assuming this is rupees in Sri Lanka. On the maturity date, what do you get? What's the amount? This is what we discussed maybe 3 weeks ago. Simple interest calculation. You place a deposit for 90 days at 10%. Principal amount is 100,000. What is the maturity proceed? How do you calculate it? Maturity proceeds equals principal amounts 1 plus interest rate, annualized rate into number of days divide by, in Sri Lanka we assume 365. This is how we calculate the maturity proceeds. That includes principal amount plus the interest. So what is the amount? 100,000 times 1 plus, what is the interest rate? 10%. So 0.1 into 90 days divide by 365. What's the answer?
$102,465. 102,465.75. Correct? That is the maturity proceeds. So you place the deposit today and the bank has the obligation to pay
102,465.75 on the maturity date. Now assume, so you hold this for 1 month. You hold this for a 1 month. Now you need money. You want to sell this in the market. After 30 days. Now you want to sell this. What is the remaining maturity of this product now? What is the remaining maturity of this product?
60 days.
60 days. Okay. Now assume you are a new investor. You want to buy this. What is the interest rate that you need? Initially, someone has placed the deposit at 10% for 90 days. Now that instrument remains only for another 60 days. Remaining maturity is only 60 days. You want to make the investment. At what rate you would invest? You don't worry about this 10%. You don't care. What do you look for? What are you looking for is what is the current market interest rate for a 60-day period and for this type of bank. Say government treasury bill is 60-day treasury bill is at say 9.5% now treasury bill. Same maturity treasury bill may be trading at 9.5%. But this is a bank. Would you lend to the bank at the same rate? You take the no, you may need more than that. So therefore, now you are as the buyer, your required rate may be 10.5 or say 11%. You need 11%. For a 60-day period investment, you need 11%. This is one of the options that you have. Then what is the price that you pay for this one? What is the price that you pay for this certificate of deposit? You are going to buy it from another investor, not from the bank. If you go to the bank and say, I want to buy a certificate of deposit for a 60-day at 11%. If the bank agrees to take it at 11%, they will give you. That's fine. But this is not that. This is an existing asset in the market with an investor. You are going to buy from that investor. What is the price that you pay? Is it 100,000? Will you pay 100,000? Or will you pay 102,465.75? What do you pay? Now, look at this. The first investor has made an investment, less than 100,000 with a bank at 10% to receive 102,465.75 on the maturity date. This is the amount. This is the amount the bank has agreed to pay. So even if you buy this and keep it until maturity, On the maturity date, you go to the bank and present your deposit and ask money back. They will pay this amount. Nothing less, nothing more. But you need 11%. Then how do you decide the price? Like in a treasury bill, now you can consider this as what? This is the face value. This is the amount the bank has promised to pay on the maturity date. This is the first face value. Then what is this? This is your required rate of return, that is yield. So you have the yield, you have the face value, you have the number of days. What do? You calculate the price by discounting this face value at this 11%, as we did for a treasury bill. That's how certificate of deposits are traded in the secondary market. Clear? So that's why I mentioned this has some elements of simple interest and some element of discount. When it goes to the secondary market, it is traded as a discounted product. But initially, it is not a discounted product. It is accrued interest-bearing product. What does it mean? You place 100,000, you earn 10% on that. So it accrues interest every day. It accrues interest every day. So it carries an interest. So that is we call interest-bearing product. At the initial point, at the inception, it is an interest-bearing product. After that, it is traded very much similar to a treasury bill or the discounted product. Is it clear? We'll move forward. Paper, certificate of deposits. Then repos. Okay, we have time. Have I explained repo transactions to you earlier? I think no, but this is very important product used by financial institutions, including central banks, to maintain the liquidity requirement or borrow funds or lend funds. First, we'll understand what is a repo transaction. Assume you have bought a treasury bill or a treasury bond. Now you have already done that. It is with you. Remember, don't get confused with treasury bill or treasury bond issuance, the primary auction. We'll discuss that one as well. Nothing to do with that primary auction. This is a already issued treasury bill or a treasury bond. No need to be a treasury bill or a treasury bond. You have a financial asset. It can be a corporate debenture or a commercial paper, or maybe equity shares, but you need a security. For the simplicity, I'll take a treasury bill because you are very familiar with treasury bills. Now you have a treasury bill. Assume you are a primary dealer in this case. You have a treasury bill, but you need funds. You need funds, but you don't want to sell this treasury bill. You want to keep that treasury bill as well in your possession, in your ownership, but you need funds for a shorter period. What do? what you can do is you find an investor who is willing to lend you money, not a unsecured one or the plain lending, naked lending. He's willing to lend you money, but you have to place a security with that investor. What is the security that you use is the treasury bill that you are holding. You have the treasury bill, you give that to the investor. Okay, you keep this as a security and give me money. That's the first transaction that you do. But not only that, when you enter into the transaction, meantime you agree with the investor after a few days. It may be overnight or 2 days, 3 days, 1 week, 6 months. Generally, this is again a money market product, so less than 1 year period. You tell on the maturity date, I'll pay you the borrowed money with the interest, then you give me that security back, the same security back. That is the future date. So we call them as two legs of the transaction, first leg and the second leg, or the near leg and the far leg. So effectively, what do you do today, now, or the first leg or the near leg? You sell the treasury bill to another party and you get cash. But meantime, you enter into an agreement to buy that treasury bill on a future date. The price also agreed today. So that's why it is called repurchase. You are going to purchase it again, repurchase. You sell today and buy it back on a future date. Both are considered as a one transaction, having two different settlements. That is the nature of the repo transaction. Is it clear? Have you got the idea what is a repurchase transaction? The party who's having a security come to agreement with another party to sell the security today and buy it back on a future date at an agreed price. That is a repurchase transaction. Is it clear? This is very important. You need to understand this because there will be a lot of usage of repo transaction. So if you are not clear, please let me know. We have to be clear on this. So that is repurchase agreement. I'll repeat it. On a repurchase agreement, a party who's having a security, treasury bill, treasury bond, or equity, whatever it is acceptable to the other party, who's having a security, come to an agreement with another party to sell that security today or the near leg. Meantime, enters into agreement to buy the same security on a future date at an agreed price. The price is agreed today itself. That is we call the repurchase agreement. From the point of view of the borrower, that means the party who is holding the security is going to give it and borrow funds. From the point of view of the borrower of the funds, we call it a repurchase agreement. So that is from the borrower's side, borrower of the fund. What it is from the lender of the fund? What does what does that investor do? He is buying a security today with an agreement to sell it on a future date. The opposite transaction of the repurchase party. Opposite transaction of a repurchase party, like a borrower and a lender. When one party borrows, the other party lends. Same thing here. When one party sells today, the other party buys today, and on the future date, initial seller will buy it and the initial buyer will sell it. So from the lender's point of view, lenders of the fund point of view, we call it as a reverse repo or the reverse repurchase agreement. That means opposite of the repurchase transaction. So don't get confused. The same transaction from two different angles, like a borrower and a lender, buyer and a seller. When a buyer buys, the seller sells. Like when one party do a repo transaction, the other party does a reverse repo transaction. That's it. That is the basic of the repurchase agreement or the reverse repurchase agreement. So it is like a mortgage or a pony. Only difference here is there's no interim cash flows in a repurchase agreement. Initial cash flow and the final cash flow on the maturity date. That's the only difference. Otherwise, you keep a collateral and borrow funds, or you take a collateral and lend funds. The borrower does a repurchase transaction. The lender of funds does a reverse repurchase transaction. So therefore, it represents a loan backed by security. So it's a securitized product. What is the advantage of doing this? If the borrower of the funds defaulted on the maturity date, then the lender has that securities. The lender can take that ownership of those securities, and if the lender wishes to sell it in the market and generate the required funds. That is the advantage. So it's a secured product. So therefore, even the rate is low. It's not just plain borrowing, naked borrowing. You have keep a collateral with the other part. You have give something as a security. So therefore, the risk of the other party is less. Therefore, the lender would agree to lend at a lower rate. That is the main concept behind repurchase transaction. And it is generally short-term transactions. Mostly months, but in Sri Lanka, I have seen repo transactions for 5 years. Generally, you don't do that. So common maturities, overnight or term repos. What does it mean by term repos? Repos may be for a particular number of days, 7 days, or it can be any number of days. But in standard terms, it may be week, 1 week, 2 week, likewise, or 1 month, 3 months, 6 months, likewise. Rollover means on the maturity date, you enter into the same transaction with the same party again. You borrow the same amount, you keep the same collateral, but the interest amount that you have to pay may be different, vary depending on the market condition. So, but you renew the transaction again and again on the maturity date. That is called rollover. Collateral, the securities that we place with the other party or the securities we sold initially, we call it as the collateral. That's the jargon we use in repo transaction. The lender takes the collateral, borrower places the collateral with the lender. Then there's another concept called haircut. What does it mean? So for the securities that you sell, there's a market value. Today there's a market value. Say the market value is 10 million rupees. The borrower cannot borrow 10 million rupees today. The lender will keep a margin there, haircut. You may be able to borrow only 98% of the market value or 95% of the market value, depending on the haircut requirement of the lender. It is generally agreed between two parties, but mainly depending on the lender's requirement. Again, that depends not only on the quality of the borrower, the quality of the collateral as well. If you keep a treasury bill, yes, very short-term maturity, even for the interest rate, the price changes are very minimal. So the risk is low. Therefore, haircut requirement may be low. But if you take a government bond, it's a long-term maturity, very sensitive for the interest rate changes, market value will change quickly. Then haircut would be high. And the market volatility, whether the prices are moving up and down very frequently at high levels, that also matters. When the markets are more volatile, uncertainty is there, then the haircut requirement is high. Then the borrower can borrow only or will be able to borrow a lesser amount at that time as well, when the markets are not calm. Margin requirement or the haircut requirement will go higher. But here the basic concept is haircut is the margin required by the lender of funds. So that is to protect the lender. On the maturity date of the repo transaction, if the borrower fails to repay, the lender would be receiving or having collateral with the market value, which is enough to cover its loss or the due amount from the borrower. That's why this haircut requirement is there. So the haircut can be calculated based on this market value and the difference between market value and amount lent as a percentage of the market value. It's like the discounting. So, but generally what happens, haircut requirement is decided first, whether it's a 2% or a 5% haircut requirement. Once you decide that, then you decide what is the amount that you can lend based on this equation. Amount lent is the market value times 1 minus haircut. Again, this 100 is there to make this haircut a decimal point. If it is expressing say 5%, then 5 divided by 100, or you can straight away put 0.05. That is the haircut. Then the reverse repo is the opposite of the repurchase transaction or the repo transaction. I explain it, so I move forward to do some calculation. So to do this calculation, we need to understand a bit about the security prices. If it is a government bond or sort of thing, especially for the time being, forget about this dirty price. Assume it's a treasury bill. Face value is 10 million. What does it mean? Face value? Face value is the amount that you are going to receive on the maturity date. but the price, current market price is 98. That means for each 100 rupee face value, you receive only or you pay only 98 rupees today to buy this security. That's the price. And the term of the repo transaction, remember, this is not the maturity of the security, treasury bill or the treasury bond. This is the term or the maturity period of the repo transaction. That is 7%. Okay. What is repo rate? Repo rate is the interest that you are going to charge on the money that you lend. In a repo transaction, we don't call it interest rate, we call it as a repo rate, but it is an interest rate. The interest that you charge is 5%. Then what are the things that we have to calculate? What is the amount that you can borrow today and what is the amount that you have to pay on the maturity date, and you can convert that to a price again to decide or to say this is the repurchase price on the maturity. But no need to calculate that specifically, you go by the total proceeds. So as first thing, we assume there's no haircut, so you can borrow 100%. So the first thing we have to calculate, what is the market value of the security. Even the face value is 10 million, current market value is less than that. So face value 10 million multiplied by the market price 98. What does it mean? For 100 rupee you get 98. So therefore 10 million you get how much? 10 million multiplied by 98 divided by 100. So the amount or the market value of security is only 9.8 million without any haircut. That's the amount that you can borrow. You cannot borrow 10 million. That is the face value. Nothing to do with that. You can borrow only the market value of the security maximum, assuming there's no haircut. So amount you can borrow is 9.8 million. Okay, now forget about all other things. You borrowed 9.8 million for 7 days at a rate of 5%. What is the interest that you have to pay? That is the repo interest. This is simple borrowing. You consider it as a simple borrowing. You know the principal amount that you borrowed, you know the interest rate, you know the maturity period. So in this, we considered 364 in the repo market as well for the 1 year period. So we have calculated the simple interest. This is the principal amount. This is the interest. This is the time. So you end up with 9,423.08 interest. Then what is the total amount that you have to pay? Maturity proceeds. That is the amount you borrowed and the repo interest. Then it is 9.8 million and 9,423.08. That is the amount you have to pay after 7 days to the lender. You borrow today 9.8 million. After 7 days, you pay 9.8 million and 9,423.08. But if you want to convert it to a repurchase price per bond or the per security, what you can do, whatever this maturity proceeds, divide by the face value, then you get the and multiplied by 100 because it's a percentage, you get this price. Now the price is 98.09. So basically you sold it at price 98 and you agreed to buy it at 98.09 at slightly higher price. What does it reflect? That reflects the interest amount that you have to pay. That is the basic of a reverse repo transaction, but we'll do another calculation with a haircut. We'll use all other same and other than the repo rate and the haircut. So first thing again, we have to calculate what is the market value of the securities. Face value 10 million, price is 98, then you get only the market value is 9.8. But now there's a 4% haircut requirement, therefore you cannot borrow 9.8 million. 4% less. So that's what is done by here. 4% less, what is the amount? Market value times 1 minus haircut. So that means market value times 0.96. It comes as 9.4 million and 8,000. So you can borrow 9.4 million and 8,000 or 9 million and 408,000. That's the amount that you can borrow, but you give to the other party securities worth of 9.8 million at today's market price. Then again, this is the amount you borrowed, 9.408. So the interest is calculated on that amount, not on the face value, not on the market value of the security, but on the amount that you borrowed. Again, go back to the basic amount. You do the same calculation, small change here. I have changed this to 9%, not 5%. It should be 9%. I think this figure is correct. Is it 8,400? Maybe check it. This figure may not be correct because in the example I have changed the repo rate to 9%. However, the calculation method won't change. Simple interest calculation. Then you add that repo interest to the amount borrowed. That's the maturity proceeds on the maturity date that you pay back. You pay 9,417,000 and something. You get the same securities. That means you should get securities with a face value of 10 million, irrespective of the price of that security on the maturity date. You should get securities with the face value of 10 million, the same security. That's how a repo transaction is worked. Again, if you need, you can convert it into a repurchase price. Any question? This is repo transaction. So then we have about open market operations. Before we go into that, is there any question on the repo transactions or anything we discussed so far? If you don't have any questions, I'll explain briefly what is open market operations. Open market operation is operations carried out by the central bank. In ours, we have a department called Domestic Operations Department. This facilitates the liquidity of the market. That means in aggregate, all banks, what is the excess fund, what is the amount of excess funds they have, whether they have excess fund or whether they have short, compared to the SRR requirement, whether they will be able to meet that SRR requirement and their other funding requirement. So depending on that, central bank either absorb liquidity from the market to the central bank, or central bank injects liquidity into the system. When the system is having a surplus, that means they have more money than they required, then the central bank try to absorb that from the system. Or if the system does not have enough funds to meet their requirement, then the central bank will inject money or the liquidity into the system. Why does the central bank do that? Is to maintain the interest rate. What would happen when there is excess fund in the market? What would happen? Everybody will tend to lend, but there are few less borrowers, or the borrowing requirement is less. Then what would happen to the interest rate? Interest rate will go down. Everybody wants to sell or the lend, so interest rate goes down. On the other hand, if everybody wants to borrow, there's a deficit, they are in a need of money, what would happen? Everybody will try to borrow. There will be a demand for money, funds. Then the interest rate will go up. So there's an interest rate corridor. What is the current corridor? Find out it. What is the current interest rate corridor? What is the standard deposit facility rate and standard lending facility rate? Those are the two rates we call. That's the corridor. The central bank tries to maintain the interest rate within that corridor, preferably at the middle level. So to do that, central bank time to time do open market operations to inject liquidity or absorb liquidity on a temporary basis or a permanent basis. To inject or absorb liquidity on a temporary basis, central bank conducts repo or reverse repo transactions. They conduct auctions whenever they think they need to absorb or inject. They do, or the central bank does conduct auctions. Okay, if central bank wants to inject money to the system, central bank wants to inject money to the system. Should the central bank conduct repo transaction or a reverse repo transaction? When central bank injects money to the system, central bank lends money and borrow or take securities as collateral. Then what it is? Is it a repo transaction or a reverse repo transaction? From the central bank point of view. To inject money,
Reverse repo.
central bank conducts reverse repo. What would happen on the first leg? Central bank gives money to the banks and receive securities. Then funds go out from the system. Sorry, I'm talking about the injection. So then other way around. Central bank gives money to the system and takes securities from the system. So there will be enough funds in the system. Therefore, interest rate will remain at a desired level. But what would happen on the maturity date? On the maturity date, central bank has to give back that securities and take the funds in. So therefore, that liquidity again come back to the central bank. The funds that injected at the beginning will flow into the central bank again on the maturity date. That's why we call through reverse repo, it's a temporary injection. If the central bank conducts a repo transaction, other way around, that means central bank absorb liquidity from the system on a temporary basis. On the maturity date, again, that will reverse. The central bank will pay back the maturity proceeds, principal amount and the principal to the banks and take back its securities. That is on the temporary basis. Then there's another facility called stand-in facility. The participant, if they wish, they can come to the central bank and lend money to the central bank at the stand-in deposit facility rate, or if a bank wishes to borrow, can come to the central bank and borrow at the standing lending facility rate. Then again, on the maturity date, the transaction is reversed. So therefore, it's temporary basis. But on the permanent basis, if the central bank wishes to increase the liquidity on a permanent basis or decrease the liquidity, reduce the liquidity on a permanent basis, the central bank can do outright purchase or sales of securities. What does it mean by outright purchase? Central bank purchase securities from the secondary market, from the participants, primary dealers and the banks. Then the money goes out from the central bank and securities come into the central bank. Or on the other hand, central bank can sell securities from its holdings of government bonds or treasury bills holdings, can sell that to the market and get cash or funds in to the central bank. And remember, that is not the primary option, selling treasury bill and treasury bonds on the auction day. That is completely different from this outright purchase and sales. These are done based on the existing already issued treasury bills and treasury bonds. But in a primary auction, Public Debt Department on behalf of the government of Sri Lanka issues new securities, new treasury bills and new treasury bonds. So two different things, don't get mess up with these two. Even for this outright purchase and sales, Domestic Operation Department will conduct an auction. Then purchasers or sellers, depending on the requirement of the central bank on the auction type, they can submit their bids to buy securities or sell securities. Through that open market operations, central bank try to maintain the interest rate at a stable level within the policy corridor. What is the policy corridor? Is the standing deposit facility rate and the standing lending facility rate. So that's all about money market that I have to tell you. So if you have any questions, you can ask now. If not, we can conclude. However, I saw small number of participants here, and yes, true that maybe one reason may be power cuts and things might have had impacted on this, but put your effort, try to join the class. Just by looking at the video, you may get what I have told in the class. But okay, during the class, if you got a question while you are watching the video, some area is not clear for you, then what do you do? If you have participated in the class, you can interrupt me and ask the question then and there, and we can clarify those issues and move forward. That will help others as well. So therefore, I again ask you to join the class as much as possible. It will be beneficial for you. That's it. That is my advice. So that's all from my side today. If you have any questions, please ask now. If not, we can wind up the session.